What's up, everybody? Tax season is soon, so whether we like it or not, um, it's around the corner. So I am gonna kind of be going over the four main kind of tax sections that you can file as a small business owner um, at the end of the year, and kind of like what goes into each category and why. It's gonna be your startup expenses, your operating costs, your inventory costs, and your capital expense. Definitely keep really good records, especially when it comes to the inventory, because that can get a little bit confusing. With your startup costs, it's going to be things like your licensing and your fees, state and local, federal fees you got to file, whatever you got to do. Legal fees, not so much for small businesses, but as you start to grow, having a team is definitely a really good idea. Your marketing and advertising costs, also market research falls into that. So if you're creating a new product or baking or building something new, that falls into that category. Travel expenses fall into this one, and also a bit into your operating costs. But I separate the two as managerial travel, things like networking, business events, and that kind of stuff, versus the day-to-day cost of driving to and from the job site or whatever you got to do, that kind of thing. That's where I separate the two. It's also going to cover things like uniforms, office supplies, and your home office tax credit if you're a home-based business. That one you have to be a bit careful with, because you do have to have a certain specific area designated for business. I have a space in my place that I just have my computer. I've got a bunch of books and things related to the work that I do. I've got some posters and stuff up in there. And it's definitely, you can tell it's an office space. It's not half office, half bedroom, or playroom, or whatever, if you have kids and that kind of thing. So it has to be a specific spot. With this, the first year that you file taxes as a business, you can deduct up to $5,000 the first year. After that, you can deduct the remainder amount in equal increments up to 15 years. So say you start a business for $20,000, right? That first year you can deduct $5,000 of that, and then you have $15,000 left. So you could deduct $1,000 a year up to the 15 years, or you could do $2,000 a year for, it would take 8 years to get the whole thing back, but you could do it that way, or whichever way you feel most comfortable. So that's how that part would work in receiving your full deduction for that. So you won't get the full thing the first year. So be expecting that. Your operating costs. This is going to be your day-to-day costs, such as rent, utilities, tips if you do that kind of thing, rent, utilities, supplies for operating, like cleaning supplies. If you run a restaurant, it's going to be the stuff that you have to order. If you own a delivery service or moving company or whatnot, it's going to be your vehicles, along with the repair and maintenance on those. This category, you can deduct everything that you spent on those things that year. So the full amount of, if you have one of your service vehicles breaks down and it takes $3,000 to fix it, whatever the problem was, you can deduct that full $3,000 on top of all the other expenses that year. So that's why keeping records and keeping receipts is a really good idea. Or at least an email about it, so you have a date of when it was done. Your capital expenses. This is going to differ a bit from your day-to-day expenses. Whereas your day-to-day are the recurring costs, your capital expenses are going to be your one-time payments. Things like buying a computer, buying, depending on your business, buying certain pieces of equipment. What else is in this category? Land, machines, buildings, vehicles, also patents and furniture. And this differs a little bit from your office supplies, where your supplies are going to be the things that you have to buy frequently, like paper, notepads, pens, sticky notes, paper clips. This is going to be more like your computers, your office chairs, your desks, that kind of thing. And these things typically have depreciative value, and that's predetermined by the IRS, by whatever scale they predetermine. So whatever, and they base it depending on how long they expect that item to last. So if you buy an office chair and they expect that office chair to last 5 years, you can deduct that cost in depreciative value over that 5 years, not all in 1 year. So that's how that works a bit. Land and stock never depreciate in value. Well, that's not true. They can depreciate in value, but because they fluctuate so much, you can't determine whether it's depreciated or appreciated until you sell it. So you can't claim any tax benefits or write-offs on that until it's sold. And then the inventory category are things that you make yourself or you buy through other vendors to sell to your customers. And you must deduct this category separately from your other ones. Keep this category completely separate, and it gets confused. It's because it gets confusing. If you buy $10,000 worth of inventory for your business when you start up, you cannot deduct that full $10,000 that year unless you sell it. If you only sell $3,000 of that, you can only claim $3,000. That's the other $7,000 rolls over as a business asset because you didn't sell it. So it gets confusing because then you have to take into account that you had to buy other inventory to replace the inventory that you sold. So the profit margin on the things that you sold is small, typically smaller. So it does get a bit confusing, which is where really good record keeping is a really great idea. Having some kind of electronic POS system or point of sale system is a great idea to helping reduce this confusion at the end of the year. And another thing that gets a bit confusing with taxes is buying things on credit. Just a little side note here, so I made sure I mentioned this to you guys. If you pay for things with a credit card, and this is how, a little bit how the wealthy do it, you gotta really pay attention. Because if you pay with a credit card, you may not have fully actually paid for that item yet, because you're paying off your credit card, right? But according to your tax forms and their tax forms, they sold that item. So on your tax forms, it's gonna, charge you for that whole thing. So you can write, depending on what category it is, you can write off that whatever amount applies, even though you haven't fully paid for it yet, if you get what I'm saying. So it does get a little confusing, but that's why it's a great idea to have somebody around who can help you out. Or it's at least a good idea to go to your local library or go pick up some books yourself, brush up on it a little bit. It gets a bit boring, but it's very, very important. It'll save you a lot of money in the long run, and it'll help you expand much faster.